Hello, this is Noah, and today we'll be talking about the balance of payments, which is an extremely important topic in economics classes. But in particular, I believe this is an important topic for IB economics and for the upcoming mock and final exams that students will have to take, which is why I thought this video, along with many others to come, would be helpful leading up to. And just a quick glance to the photo here that I selected, the balance of payments, right? And we see, two coins bouncing vertically on the table. So I thought that's a pretty cool, uh, you know, photo if you want to capture a literal meaning. A quick definition here, according to IB Economics, the textbook which I referenced. The balance of payments of a country is a record, usually for a year, of all transactions between residents of a country of the country, rather, like a domestic country, and residents of all other countries. So we're accounting here for foreign countries. And a bit of terminology below that you'll come across a lot, credits and debits. And credits are payments made by foreign countries, and debits are payments made by domestic countries. And then we begin to deal a lot with inflows and outflows, but we'll get to that. Uh, Now, an explanation here. So, the purpose of balance of payments is to provide information on the foreign countries that engage in a lot of business transactions to see whether a country has a deficit or surplus. Those are also very important economic terms that you'll come across. Now, theoretically, the balance of payments made by countries, right, when we're accounting for the credits and debits here, altogether, the balance of payments made by countries should amount to zero, right? And at the same time, we're considering this theoretically, but in a real world scenario, this is rarely the case. We don't find this with many countries. It'd be great, it'd be ideal, but it's not very common. So within the balance of payments, there are three different account types that are factored into the economy of a country. And those are the current account, the capital account, the financial account. And that's where we see these uh, terms, get thrown in, right? With credit and debit and deficit and surplus. And we're going to look a little more at this. So I'm taking this table right here from the IB Economics textbook. And this table essentially outlines how the current, capital, and financial accounts factor into the balance of payments and what components make up each of these accounts for a better understanding of what we're dealing with. So let's look a little bit at the current account. So as you can see, the current account has rows such as the export and imports of goods, the exports and imports of services, and more. So we're going to look at those first. So the current account accounts for the inflows and outflows of goods and services into a country. So when we see that there is a positive 40 in the exports of goods right here, and that is basically a positive unit displaying a surplus of exports, meaning that we're exporting quite a bit to the other countries. However, given the fact that there are imports, the imports unit here is minus 65. There's a deficit of the balance of trades in goods overall, uh, because positive 40 and minus 65 amount to minus 20. So there's a deficit overall because of the fact that we're importing a lot more than we're exporting, meaning that there's a lot more money coming out of the domestic economy than is coming in. And that's because residents are importing foreign goods, meaning that they are spending a lot more on foreign goods while the country is not exporting their goods to foreign countries. And therefore, they're not producing as much revenue to keep up with the deficit that imports have created. And we can account for this deficit by looking at the sum of exports and imports of goods, right? And we can also do the same for the balance of trade in services, which is positive overall. So we've accounted for the exports and imports of services in this table, positive 25 minus 25, and we see that there's an overall surplus here. So in the balance of trade in services. Now, the current account doesn't just account for the inflows and outflows of imports and exports into the country, but it also takes into account things like income and current transfers. Now, income in this case is referring to the inflows into a country of rents, interest, and profit from abroad, minus the outflows of rent, interest, and profits. Current transfers accounts for the inflows and outflows of gifts, remittances, foreign aid, and pensions. So, for IB students, we can make this connection to exchange rates when we think about factors that cause changes in demand and supply in the foreign market, such as remittances, where supposedly a native French person works overseas in Thailand and may spend their money home or send their money home to France. When we have our balance on a current account, which appears to be minus 20, well, some may say, that's not really a good thing considering how we would like zero, but you also have to take into account, we need to take into account the capital account and the financial account that hopefully, supposedly, balance out the current account. So let's do that. So the capital account has two items, as you can see. There's capital transfers and transactions in produced non-financial assets. Now, capital transfers account for inflows and outflows of things like debt forgiveness, non-life insurance claims, and investment grants. The next row is transactions in produced non-financial assets, but it's actually supposed to say transactions in non-produced non-financial assets. Before you get confused, it is actually really easy to understand. Essentially, it refers to the inflows and outflows of funds into the country due to the transactions of natural resources that have not been produced. So an example of this supposedly is land or even water. Now, as you can see, the balance on the capital account is actually a positive one, which can reduce the current account deficit in the overall account that we saw on the previous slide. Now moving on to the financial account. So the financial account is the last account with four items. Firstly, foreign direct investment, or FDI, accounts for the inflows and outflows of investments by foreigners into the domestic economy and investments conducted by domestic investors. Secondly, portfolio investments account for the inflows and outflows of investments in in financial capital, such as stocks and bonds. Thirdly, reserve assets account for the foreign currency reserves that the central bank can buy or sell to influence the value of the country's currency. Now, this is a little tricky to comprehend at first, as it is an item uh, that is unlike the inflows and outflows of capital and goods and services. Rather, the central bank of the domestic country can buy or sell foreign currency reserves to ensure that currency appreciates, depreciates, or stabilizes. So, suppose Canada has US foreign currency reserves. If it sells USD by by selling these foreign reserves, it does this by buying its own currency, Canadian dollars. This means that there is an inflow of its own currency, contributing to a credit to their financial account. And the opposite is true because if they buy foreign currency reserves, they buy it with their own currency, and there is a debit in their financial account. Finally, official borrowing is when the government borrows money from foreign countries or lenders. By borrowing money, there is an inflow of currency into the domestic economy, appearing as credits in the financial account. If the domestic economy lends to foreign governments, there is an outflow of currency, and thus debits appear in the financial account. So now we have that understanding of current capital and financial accounts. We can now make a connection to exchange rates with the balance of payments. You see, if you don't know already, exchange rate diagrams here, show the demand for a currency and the supply of the same currency in a foreign exchange market. So a way to think about it is you are some foreigner who wants to exchange their USD for Mexican pesos because you want to buy products from Mexico. You want to import them. So there's a demand in foreign exchange market for the pesos, but there is a supply of but is there actually a supply of that currency? Well, suppose there is a demand for imports to Mexico by Mexican residents. Well, they will exchange their money for other currencies, leaving behind a lot of pesos in the foreign exchange market for consumption. And in a perfect world, we hope for an equilibrium between the levels of demand and supply forces um, in this exchange market. So, going back to the balance of payments, exchange rates can be affected by inflows and outflows of currency into the domestic economy. Now, a great example of this is when we look at the current account. A lot of the time, we associate current account deficits with more outflows of money through imports than outflows of money through export revenue. With that being said, there will be more supply of domestic currency as residents exchange their currency for other currencies to purchase their imports. With a current account surplus, there are more inflows of money than outflows, which could potentially mean that there are more exports demanded than imports in the domestic economy. With that being said, there is more foreign demand for the goods and services that this country has to offer. So there will be an increase in demand for their currency to purchase these exports. The same goes for capital inflows and outflows, where increased FDI can lead to increased demand in the foreign exchange market. Now, taking all of this into account, we see the relationship of how credits in the account cause increased demand in the foreign exchange market, while deficits in the account cause increased supply in the market. So when the credits and deficits add up to zero, there's a balance of payments. When the increased demand and increased supply levels come toward in a diagram for the foreign exchange market, we can see that there is an equilibrium formed, as shown above. Now, the very last thing that I would like to cover in this video, in terms of content, is the relationship between the balance of payment and production possibilities curve. Now, this is also very important to understand. As well known, a trade surplus in the balance of payments means that there are less purchases being made by the domestic country for things that foreign countries possess, and that the foreign countries are consuming a lot more from the domestic country, right? They want more of those exports or imports to them. Therefore, this country consumes a lot less than what it produces, so it will be within the point on the PPC, the production possibilities curve. Now, the opposite is true for a trade deficit. A country is purchasing a lot more from other foreign countries and producing a lot less for other countries to buy. So it is going beyond the PPC as there is an increase in allocative efficiency. The country, in other words, is getting a lot more than is theoretically possible, according to our previous understanding of what a PPC curve is. So now here's question time. So I found this question to be very good at testing your knowledge on the balance of payments. It's actually a question that I received in my economics class, so I felt as though it would be extremely helpful to go over it. So we are given a table of the balance of payments of a country called Urbania. So right off the bat, we actually have the current account deficit listed here, which is 125 million. Given the fact that exports of goods, imports of goods, exports of services, imports of services, net incomes, and net current transfers are all part of the current account up to this point right here, we know that the sum of all of these components will add up to minus 125 million, given the fact that the current account is in deficit, so it's a negative number. So now we can actually find V first, as asked of us in the first question, and we can do this by actually adding up everything in the current account, including the V. And what we can do is we can isolate for the V. So we have the exports of goods, imports of services, imports of goods, exports of services, imports of services, etc. We add all those up, including the V, and then we isolate for V. And we get V equals minus 3,915. Now that we have that number, we can actually calculate W, which is asked of us in the second question here. And the reason is because the total account must equal 0 altogether. So whatever number remains before W is what will be resolved by W. So everything before here, there will be a number for that, and W will resolve the remainder of that number, right? For the balance of payments to equate to 0, right? In an ideal world. And in this question. So basically, you can see here the math. We've added up everything, including the V, which is already solved for, which is now the minus 3,915, which we've added into the equation. So we've added all of these components here, and all of that equals minus 19. So as you can see, we are currently we have a deficit. But in order for the balance of payments to equal 0, we need W to cancel out that deficit. So W plus minus 19 will equal 0. That is the equation we want to use. And once we do that, we can isolate for W. We get W equals 19. So we know reserve assets equals 19. Now, with all that, I hope you found this video helpful. Here's a list of references for you to take a look at. Thank you very much.